European analysts said the financial sector reforms put into place in the wake of the global financial crisis 15 years ago have so far helped protect European banks from being hit harder by the ongoing banking crisis. But the latest round of problems have still not fully run their course. The current banking sector fragility was sparked by the collapse of two regional banks in the United States, Silicon Valley Bank in California and New York's Signature Bank, soon after Switzerland's Credit Suisse shed nearly a quarter of its value in one day, March the 15th. But markets were caught earlier this week when UBS, Credit Suisse's main rival, acquired the troubled lender for around $3 billion. According to Lorenzo Rocco from the Department of Economics and Management at the University of Padova, it is unlikely that Credit Suisse will be the last large European bank to fall under pressure during the current crisis.
What is more concerning, in my opinion, is for sure the Credit Suisse crisis. And in principle, this might have, large consequences on the other banks, because all the banks at the end of the day are connected, and the largest is the bank who's in trouble, the more the waves spread across the banking system, right?
Another analyst noted that banks are required to have more liquidity than they did before, and the internal capital for banks is higher, but there are still risks for the weaker banks.
We have to tell that at the European level, we have a system that right now is a little bit stricter with banks. So right now, still, the risk is there because there's a strong tension on the market. But right now, the European bank is a little bit stronger. And when I speak about European bank, I speak about the bank inside the European Union system. So Switzerland has a different system. And also, this is the reason why probably Credit Suisse has this big problem.
European stock markets have just ended their second consecutive week of high volatility. On Friday, the week's final session, shares were mostly lower. Over the past 10 sessions, European shares broadly fell 7 times, with banking sector stocks the main reason for the ups and downs.